Thing. Yeah, it's pretty good. Whakarongo mai rā ki te kōpara tū whārangi. Tō ara ki noho puku. E piriki o rangi, e piriki o rangi. Tihei mauri ora. Ko te tai whakarunga, ko te tai whakararo. Ko te tai tōkarau, ko te tai tonga. Ko te tai hawauru, ko te tai rāwhiti. Tēnei, ko te tai ōhanga. Hui e, tai ki e. Ki te whari, i ngā makapuna a tānei, tēnā koe, ki te mihi, kei te mihi. Kia koutou ngā whanaunga, taranaki maunga, taranaki tangata, ati awa, kei te mihi. Kia koutou ngā manuhiri, tuārangi. Kua tai mai i tēnei rā, hau mai, nau mai, haere mai. Te pai tapu, tēnā koutou, kei te mihi. Ki te kaupapa o te ata, kei te mihi. Ko tainui te waka, ko whitireia te maunga, ko raukau te moana, ko Ngāti Taua Rangatira te iwi, ko Chris Parker tōku ingoa. Nō reira, tēnā koutou, tēnā koutou, tēnā koutou katoa. Hello everyone, I will pass you to our chair in a second. I'm from one of the local iwi, so I offered to give a mana whenua introduction. I gave our opening karakia, which is to put us into a state of tapu so that we can concentrate on the issues at hand, get right into the detail, and at the end I'll give a closing karakia so we can leave the baggage at the door and walk out free and easy. And I gave acknowledgements to our wonderful wharanui around the corner, to other mana whenua in the area, to yourselves, our esteemed guests, to our great panel, and to the topic under discussion today. So thank you, Tim.
Kia ora, Chris, for that mihi. Tēnā koutou katoa. Good morning, everyone. I'm Tim Ing. I'm a senior economist here at the Treasury, and I'll be your chair for this session. Let me quickly provide the quick health and safety briefing for all those in the room, and then we'll begin the seminar. Bathrooms can be found just on the left of the kitchenette, just out the doors here. And in the event of a fire alarm, please follow Treasury staff to the nearest exit and progress down the stairwell to evacuate the building. Please don't use the lifts. In the event of an earthquake, it's drop, cover and hold. So drop to the floor, grab something to cover and hold onto it. And please stay in the building until you're further instructed by a warden. Thanks very much. All right, so the Treasury is very pleased to present today's seminar jointly with Motu Research. Many thanks to our colleagues from Motu for proposing the idea and for working with us to bring this event together. Our topic is Treasury's updated discount rate framework and how it will be used to guide the valuation of New Zealand public sector project proposals. As you'll have noted in the flyer for the session, last year Treasury made some major changes to its discounting guidance, which has been around since at least the 70s. As well as to the discount rates themselves, and our panel will talk about that. The guidance now sets the discount rate for non-commercial proposals considerably lower than that for commercial proposals. This has important implications for the valuation proposals intended to promote long-term social and environmental outcomes relative to purely commercial proposals. And our speakers are going to explore the issues concerned with that change today. Judging by the number of registrations, there's a lot of interest in this important topic, perhaps reflecting that for some time it's been one of the more controversial in public policy in New Zealand and elsewhere. So it's great to be able to host 4 extremely knowledgeable speakers today to talk about the substantial work they've been doing, and they have done and are doing, on public sector discounting. Their work has led to the development of our thinking behind the new guidance. References to supporting papers for the session, which I heartily commend to you, are listed in the flyer. First up on our panel will be Professor Arthur Grimes. Welcome, Arthur. Arthur is a Senior Fellow at Motu Research and Professor of Wellbeing and Public Policy at Victoria University of Wellington's School of Government. Arthur's current research focuses on the economics of wellbeing and public policy and on urban and housing economics. He's published widely in both these fields and has published also on monetary economics and related topics. Second, we have Chris Parker, who is a Principal Advisor in the Treasury's Housing and Urban Growth team. Welcome, Chris. Chris is an economist with expertise in cost-benefit analysis and urban policy. Previously, he was Chief Economist at Auckland Council, Consultant at NZIER, Hyder Consulting, and at the Foundation for Research, Science and Technology. And thank you once again for our mihi this morning. Third, Geoff Simmons is the Chief Economist in the Office of the Parliamentary Commissioner for the Environment. Geoff has worked as an economist for the Productivity Commission, the UK Home Office and the New Zealand Treasury, and has served as a general manager at the Toi Mai Workforce Development Council and the Morgan Foundation. Geoff has co-authored 4 books, 2 of which include a focus on environmental economics. And finally, Kirsten Jensen is a principal advisor in the Treasury's Public Finance Policy team. Kirsten led Treasury's policy work on public sector discounting and leads the Treasury's work on public sector cost-benefit analysis and the use of the CBACS modelling tool for policy advice. She has served as a director on the board of the International Society for Benefit Cost Analysis. Welcome once again to our panel. Each of our presenters will speak for around 10 to 20 minutes, and so that we can keep things moving, I'll take questions for our presenters after they finish speaking, please. I'll take questions from the room and from our online audience. Please bear with me as I attempt to manage questions from both online and in the room, which is not as straightforward as it might seem. In the interests of covering the range of issues, as usual, I'll be trying to group the questions up into themes. I anticipate quite a few questions, actually, given how many people there are. And that also means probably that we won't get through every single question, so I apologise in advance if I don't get to your question. For folks online, please post your questions using the Q&A button in Teams. That's the one beside the chat button. And then I'll be able to see your questions. You can do that throughout the presentations. Please feel free to do that. If you experience any connection issues, please use the chat button, not the Q&A button, and that will go to your issue will go through to our tech crew who will look into it. Our first speaker is Professor Arthur Grimes, who's going to talk about the theory of discounting and new approaches to setting social discount rates. Arthur, please.
Thanks very much, Tim. It's great to be here and great to be here. Oh, hang on. So probably some slides that Tim should have talked to. There we go. It's great to be here on this topic. It's one that I've been involved in for many years, and in particular was asked by Treasury last year to give some advice, and unusually it may have had an effect. It's fantastic. Now, what I want to do is just a little thought experiment first, and I want you to. You've got a choice between if somebody reputable like Tim said, "I'll give you $100 today," or "I'll guarantee you to give you $104 in a year's time." And I want you to put your hands up. Is to close your eyes first so you can't see what everyone else does. Close your eyes. Okay. Do you want $100 today? Or okay, and hands up if you want $104 in a year's time. Okay, so that's about 80-20 for $100 today. So in other words, all of you are discounting the future. Okay, you're preferring a smaller amount today than what you would be getting tomorrow. That's the case with most people. I asked this of all my classes, and all my students tend to discount the future and then say we shouldn't. It's very interesting. So from a public policy perspective, it's the same issues, right? What should we have today versus what can we have tomorrow, next year, 10 years time, 2 generations time, or whatever. It's the same basic idea. This is really what the topic is about. How do we then do in public policy? What sort of discount rate should we use when we're talking about trading off returns in the future for returns now? So just, the theory of it, Partha Dasgupta, a very famous economist who actually taught me, said, society now conducts a thought experiment by asking how much additional consumption it would demand on behalf of tomorrow's people in payment for a reduction in today's consumption by 1 unit. So when economists are thinking about discounting, we're thinking about not trading off money so much, but trading off what we can get in terms of resources in the future versus today, or consumption in the future versus consumption today. So that's really the framework that Partha Dasgupta has got there, and many other economists, Arrow and others, have talked about it in the same way. So the social discount rate is basically that trade-off. Essentially, how much are we prepared to trade off consumption today versus consumption tomorrow in a public policy sense when we're evaluating proposals. And that then leads to a major issue about how we should set the social discount rate. Because you imagine for public policy, we're often dealing with very, very long-lived payoffs. Okay, payoffs 2, 3, 5 generations ahead. Once you start discounting those in a standard way, they become almost worthless, as we'll see. But there are both technical issues at stake and ethical issues at stake. And I think sometimes we forget one or the other, but they're both important. So what are the key issues? Well, the first one is just jargon, but I'll explain it later. So we've got two different ways of setting a social discount rate. One's called the social opportunity cost of capital, and one's called the social rate of time preference. And I'll discuss both of those in a minute. There's how we discount. The standard way we discount is through an exponential discount rate, the same as compound interest. That becomes very, very large as we go through the amount of discounting if you use exponential. On the other hand, there are other forms as well, which, in fact, the Parliamentary Commissioner for the Environment suggested that Treasury look at. There's one that I think is important and hasn't been looked at much in the literature, and that's that there's an assumption that we have a single rate of what's called pure time preference, how we value consumption tomorrow versus now, and we apply that to everything. We apply that to all goods in the same way. We apply it to marshmallows today and next year, and to river quality today and river quality next year. I see no logic at all for that assumption, yet it's ingrained in virtually all economics literature. And a further one is how we treat future generations. This one has come up in the literature, and then keeps on getting put into a too hard basket. When I'm talking about the discount rate, by the way, I'm talking about the real rate, so after taking account of inflation, and if I refer to any numbers, it'll be in terms of the risk-free real rate per annum. Okay, so risk-free, that's an important point, which we'll come back to. So what was this social opportunity cost versus social rate of time preference? These are the two common approaches. Treasury traditionally has used the social opportunity cost approach to determine the discount rate. Now it uses both approaches, I would argue. I think that's how I would interpret their new policy. So basically, the social opportunity cost of capital, what we've done before, is basically saying, well, if I could have a similar investment in the market, what is the return that I would get on that investment? And that's the opportunity cost of investing in whatever I'm going to invest in for public policy. So the important thing is there that you have to be comparing two investments with the same risk profile. Otherwise, it doesn't make sense. So what's the if you like the return in terms of once you've compensated for risk in the market versus what you would and you apply that to public policy. That's one approach. The other approach comes from welfare economics, and it basically says we have a social welfare function over current and future people and what they value, and we consider the optimal discount rate in terms of what maximises what economists would call the utility or the welfare or the well-being of people now and in the future. And these two approaches have conceptually different ways of thinking about things. But it turns out, well, actually, I'll come at what it turns out in a minute. Traditionally, Treasury used the social opportunity cost approach and with exponential discounting. So as you'll see with the little diagram there, what it means is that after a number of years, you're actually discounting future returns by a bigger and bigger and bigger number. In other words, you're dividing through by an exponentially increasing number. So any return that happens in, say, 25, 50 years' time is hardly worth very much when you value it today if you use a standard sort of discount rate. And it used to be, when I first started in this game, Treasury used 10% real, then 8%. I opposed 10%, 8% I opposed, 6% I opposed, 5% I opposed. And then now they're doing something sensible. It's great. So there is another approach, though, other than exponential discounting, which I say that the PCE had suggested that Treasury look at, and I looked at that. And that is that actually in practice, if I'd have asked you that first question about 104 versus 100, if I'd have said actually $100 next year versus $104 in 2 years' time, many of you would have said $104 in 2 years' time relative to 100. So what tends to happen is people discount a lot between now and the immediate future, and then a small amount of discount after that. And essentially, that's consistent with what's called hyperbolic discounting. And this is the guy who was a psychologist who came up with this as an observed way that people actually discount, Richard Herrnstein. And the only problem with this is it leads to inconsistent decisions over time. Because basically what it's saying is if we might apply, in 2023, we might have applied a very low discount rate between 2024 and 2025, because that's 2 years out. But once we get to 2024, we apply a high discount rate between 2024 and 2025. So it's inconsistent over time. There was a version of this that Phelps, this is a picture of him when he won his Nobel Prize. It'd be quite nice to win one of those just to get the costume, wouldn't it? And as well as the $1 million. And anyway, he came up with quasi-hyperbolic discounting, which basically just said you discount a lot between now and next year, and then you discount by a small rate after that, but then it's exponential after that, but with a very small rate. That's called quasi-hyperbolic discounting, but that has the same time inconsistent problems as hyperbolic discounting. So I don't think either of those actually are an appropriate approach for public policy, because public policy should be consistent over time, in my view. Not that it is, but it should be. And just to give you a feel, you'll see that the scale here has changed from 20 years beyond. But just if you look at the black line there, the solid black line, basically it's saying if you used a 5% real discount rate by the year 20, where the horizontal axis changes, by year 20 you'll be valuing $1 of benefit in 20 years' time at only 40 cents. And if you go out to 100 years, you're basically valuing it at zero. So you think about investments in environmental aspects or various other social aspects, like the social investment approach. If you're thinking about a social investment approach that pays off for the next generation or the generation after that, you don't care with a 5% real discount rate, and because who cares about 2 generations' time? It's basically worthless. Frank Ramsey, in 1928, one of the most famous, one of the greatest economists, he didn't quite make the 27 club. He died when he was 26 with an output of probably more than any economist before or since in their entire lifetime. He actually showed that under various assumptions, these 2 different ways of approaching discounting are the same. The social opportunity cost, which is the R is the rate of return on the alternative investment, is actually equal to your innate sort of rate of time preference between consumption today and consumption tomorrow, and some rate of your consumption growth. And the idea basically is that the higher your consumption growth over time, the richer we get over time, the more we want to bring that forward to today to smooth our consumption. So we would apply a higher discount rate if we had high income growth over time. Otherwise, if it was static, we would apply low discount rate over time. Some issues with these approaches, which I alluded to first of all. First of all, what we've seen in more recent literature is that if there's uncertainty about what the true discount rate should be, you actually get a declining discount rate over time, even optimally, even if you're using exponential discounting. And Marty Weitzman, famous environmental economist, etc., has shown that, and that might be talked about in one of the later presentations. As I said, I believe there's a problem that we traditionally discount intergenerational matters at the same rate as intragenerational matters. So in other words, just because I might discount my future consumption over time doesn't mean in public policy we should discount our children's or grandchildren's consumption over time. And this has been a fundamental problem with the discounting approach that's been used in the past. And also, as I alluded to at the start, I think there's a problem that we assume that we apply the same discount rate to everything. Whereas I don't think that is an appropriate way of doing it, even though it's ubiquitous in the literature. And so just to give you an example of this, I think most of us would care strongly that democracy is preserved for a future generation. And we would hardly discount that at all, whereas we might well discount the state of the beehive, the building itself. We don't really care if the beehive is left intact for our grandchildren too much, but we really care that democracy is left intact for our grandchildren. What we're doing then is applying 2 different discount rates. Even for ourselves or for our intergenerationally, we're applying them 2 different discount rates to different goods. And this has not been really observed in the economics literature in the past. For some reason, it's an oversight. Saying we may care more about water quality in the future rather than about the car park in the future or something like that. So And basically what that's implying is that we've got different discount rates for different goods. And that's quite consistent with standard economic theory. It just has been overlooked. I mean, if one goes back to the sort of Bible for when I was being brought up in economics, De Breu's theory of value, that allows for the different discount rates to be there. So what I've argued is that we should adopt different rates of pure time preference for different goods. And we'll see the Treasury now has got different rates for non-market and market goods. I think that maybe could be more fine-grained than it is, but you have to settle on something that's easy, that's definitive. So I don't have a problem with that in a public policy sense. And we should adopt a different rate of time preference for intergenerational trade-offs versus intra-generational trade-offs. And we shouldn't discount too much our future generations' welfare. And interestingly, that was proposed by Robert Barrow back in 1974 in a very, very famous paper, Our Bonds Net Wealth. And he argued that we should have different rates. And again, that's been overlooked since he did that. That's a picture of Bob when he it's not his Nobel Prize winning attire, I don't think, but he also won the Nobel Prize. And but it was from his work there that he basically says, no, we should apply a different discount rate to future generations than we do to today. But that's really been overlooked in much of the discount rate literature. And so just an example, I place a great deal of weight that my grandchildren can access a clean river, and when they are young, even more than whether I can access a clean river in the same year. And so I think it's important, I've got a different rate of discount for my grandchildren than I do for myself. I put, it's higher than, it's a lower discount rate than I apply to myself. So these concepts lead to three practical recommendations. One is that if we're dealing with market activities, and this is dealt with much more in my paper, but we should be discounting market activities of the government and public policy at the same rate as the private sector does. In other words, use the social opportunity cost of capital. And the reason for that is otherwise it would be worth the government basically taking over the entire private sector because it would be using a lower cost of capital, essentially. So that really doesn't make a lot of sense to do that. So from a public policy perspective, if the government's investing in a new insurance company or something like that, it should use the standard market rate. For non-market activities, at least for some non-market activities, they should be discounted at a lower rate. In part, that reflects a lower intra-generational rate of time preference. I prefer, as a public policy person, I value future rivers highly relative to future car parks, say. But also we should be using a declining discount rate over time to take account of the need to acknowledge that future generations deserve some of these goods in perpetuity, if you like, rather than us just essentially stealing them from them. And these recommendations are mostly pretty much consistent with Treasury's new approach to discounting, different rates between market and non-market activities with a declining discount rate for the non-market activities over time. So in broad brush, there's some fine differences, but in broad brush, these concepts, I think, are consistent with what Treasury is doing. I'll leave it there. Thanks, Dick.
Well, thanks very much, Arthur. Chris, please.
Thank you, Arthur. Yes, so I am going to speak about two main topics. One is how do we put a specific number on the social rate of time preference, given that our policy that Kirsten will talk to is to have two discount rates, a commercial social opportunity cost and the social rate of time preference. So I will talk about that, some of the approaches and key assumptions, and point out it's a piece of the puzzle. It's a really important piece, but it's not the picture. So I will also reflect a little bit on how things are going so far with the dual discount rate. How do you discern commercial versus non-commercial? So Arthur gave us a bit of a description of the social rate of time preference, notionally what it's about. It has a lot of normative or ethical components to it, but also has some descriptive elements to it as well. So it's not a mere technical exercise. As Arthur said, it's a real number. So as we've deployed it, some people have interpreted 2% as if it's nominal and compared it to the borrowing rate of about 4%. So if you add inflation of about 2%, it means about a 4% nominal social rate of time preference. So here is a table of the key assumptions. We've recently published a working paper with the details in it. It's a technical paper. Some of the key things that we've done here that's a bit different than maybe the current state of the literature is having a relatively simple equation for the social rate of time preference. So, but much like Arthur had, we have a pure rate of time preference where we discount the future just because. Then we've got a consideration for the extent to which our society might be wealthier in future. When people are wealthier, they're declining. Well, their marginal utility is declining. So every dollar that they get is going to be less than if they were poorer. Yeah. So the richer they are in future, the more we'd want to smooth consumption over time by bringing that forward. The other, when I was looking at this in a past life, it was probably about 2016 when I left the sector, and a big development that happened since was adding on quite a complicated expression at the end to deal with uncertainty in the growth rate. We've decided not to go down that. It was probably in policy you rather be broadly right rather than precisely wrong, and 80-20 rule applies, and that was probably a bit peripheral. And so one of the approaches we did, bearing in mind that the advice was also that to use the Weitzman approach to doing the decline in discount rate. So I'll talk about the specifics in a moment. And to do that, what we thought was these moral parameters and assumptions, we could pick quite plausible ranges, and some of those ranges are quite wide. And one number is as relevant as another. So there's uncertainty, maybe not in the parameter itself, but uncertainty for us about what to choose. So we codified that uncertainty with ranges, and that spat out a range of outputs, which we did the decline in discount rate methodology. Some of the key things that drove us to come up with a relatively low rate of time preference, which is about 2% real, is the low forecast real growth rate of consumption, which is depressing. A relatively low value of the curvature parameter of the social welfare function, which represents how quickly does utility or social welfare decline as consumption increases. Some literature points to values between 1 to 4 based on people's individual behaviours around risk aversion and savings. But as Arthur said, that might be fine for describing a particular person's behaviour, but it's quite it does not logically follow that that's how we ought to do public policy from a social society-wide perspective. The way that we did it was to interpret it in terms of the aversion to inequality. How much, with a thought experiment, how much would you be willing to take off of someone wealthier, lose a lot on the way to give to someone poorer? And values of 1, 2, or 3 would imply that we would be willing and quite happy to lose nearly all of it and to cut our nose off to spite our faces. And having benchmarked the extent to which we're willing to transfer wealth and income in our social welfare system, that help guide lower values of that parameter than is used in the literature. So the mean is about 2%. Some people have asked, how do we get that? Well, you can just take the middle value of most of those parameters. Then the range of discount rates varied between 0 and 4%. Another novelty that we did, because we were doing this Monte Carlo, which is grab a value from one of the input ranges and see what the net effect is overall, is that we could come out with discount rates that were less than the growth rate, which would lead to a bit of an absurdity that you would have infinite social welfare if you were then trying to conceptualize it in a social welfare function. So we put a boundary on that and discarded those particular draws. So that led to the range of discount rates that we estimated being higher than they otherwise would have. From that middle chart, we took the decile ranges and plotted them to find out the corresponding discount factor. So this is the Marty Weitzman approach, and found what the simple average equivalent discount factor is, which gets smaller as you go out in time. And then from that, back out what that implies about what the discount rate would be. And it implies a declining discount rate. The average is declining, and the marginal is declining even more, which is that blue curve. And We were inspired probably by the UK Treasury to have a simple schedule of declining discount rates. So cobwebbed that around, trying to minimise the number of corners and weird numbers in a way that kind of was about right. And yeah, the technical paper drills into some of the other considerations, and that's available on our website. There's a couple of extensions that might be possible, as Arthur talks about in his paper, the taking into account project-specific risk, such as correlation between the benefits and wider economic benefits. So that's usually done through the consumption CAPM model, which I've not considered here, but could be done in future. Although I don't expect it would come out with a large impact because we use a fairly small curvature parameter on the social welfare function. So, and another consideration is, now that we're using a social rate of time preference, whether the shadow price of capital might be relevant, which is where you explicitly model the accumulation of capital in the whole economy, look at the benefits that arise from that, and discount that with the social rate of time preference to consider if certain policies are better at promoting or the accumulation of capital, or certain policies degrade it, then you can give an additional premium for that, which might be relevant as we're now thinking about how to lift productivity in a more enduring sense. What I'll also talk about briefly is how we're going with deploying the new dual discount rate policy. So it was really following Arthur's direction to use a commercial rate for commercial stuff and a social rate for social stuff. So that's basically what we did. We've got Kirsten will talk about the way we deploy it, and we require both discount rates to be used to see, does it matter? Because it might not matter if the proportion of benefits and costs each period is the same each period. It matters a lot for infrastructure projects that have big costs up front and long-term benefits. So we're working on some guidance on how to deploy this. I come from a CBA cost-benefit analysis background, and so I was fairly accustomed to thinking about what the market failure or problem definition is. What's the fundamental rationale for government intervention? And that in public policy, we often talk about the concept of additionality. So yes, an intervention might be beneficial, but if it was going to happen anyway, then what's the additional benefits over and above that? So one of the CBAs can take that additionality into account explicitly, or they can not and rely on that heavy lifting being done by the discount rate. So what does it mean for additionality in a CBA? In my mind, it means that you can, if you're doing a policy working on the system rather than in the system, like you would if you're a firm just taking prices as given, you might model what would happen in the absence of public policy intervention, who would enter, what goods and services would they supply, and then model what would happen with the intervention and subtract one from the other to look at the net impact over time and then discount that back. So if there was an intervention that the private sector was perfectly good at doing, there was no reason why they couldn't pick up that $100 note sitting on the ground, then it stands to reason that you wouldn't expect any additional costs and benefits to be expressed in the CBA, regardless of what discount rate you use. So depending on how the CBA is conceptualized, probably depends on how the discount rate should be operationalized in our guidance. That said, if there are certain activities that the private sector wouldn't do because it's not viable at the commercial discount rate, that logic doesn't stand. So that's where things get really interesting for us at Treasury and the wider public service, as we start to think about, well, is it quite commercial? Does it have a lot of commercial revenues that make it almost viable? Because if so, then the comparative institutional analysis that we might do about the relative pros and cons of markets or government come to the fore. And we've done a lot of thinking and have a lot of useful frameworks on this. So what we'll do is apply a CBA lens to those judgments. And the guidance that we're developing will be useful for PPPs, institutional design, and one of the other reflections when I came to government about 9 years ago was we don't do a market failure analysis in our CBA. Treasury revoked our guidance on how to do that. We've relied just on the discount rate to do that. So most of the things we do across government are legacy. And when I ask people, do you have like a one-page description of what the market and government failures are that justify your intervention? Much like the only other place I've ever seen that is probably in a ProgCom inquiry. And most people don't have that. So there's a huge opportunity here to enhance how we think more critically about the role of government and the role of markets. And I think that's pretty exciting. People are a bit frustrated, we don't have the answers, but I'm really pleased people are starting to even ask the question. That's a big win. I'll just leave it there. Thanks.
Thank you, Chris. Right, so our final two presenters are going to double team it, I think, which is Geoff and Kirsten, please. They're going to talk about the policy implications of the recent changes to the guidance.
Kia ora koutou, ko Geoff Simmons toku ingoa, ko te kaitohu mātua ohanga ki te kaitiaki taio a te whare pāremata. It's an honour to be on such a distinguished panel and to be speaking in front of such a distinguished audience. So, where are we? Policy implications. So first up, on behalf of the Parliamentary Commissioner for the Environment, I really want to congratulate Treasury for the process that they went through to develop this revised set of discount rates. It was, as everything in the public sector does, it took some time. This report was, I think, back in 2020, but it was a thorough process, and as you can see by the work that Chris and Arthur have talked about, we're very well considered, and I think it's a great outcome. Now, Parliamentary Commissioner for the Environment cannot claim credit for this idea at all. We were but one of many people, as Arthur said, who have been talking about these issues for a number of years, but I'm going to take a little bit of credit because it's one of our recommendations, and that's what we get measured on. So if anyone from the Office of the Auditor General here, take note. So just to talk about the policy implications of of the change in discount rates, Chris has already talked about the importance of this for infrastructure. I would argue that it's going to have an even bigger effect on the environmental sphere. We hear things like nature-based solutions and green infrastructure, but a lot of our processes are not well suited to such concepts, and a lower discount rate will really help in that respect. You can see from this graph, a 2% discount rate is going to lead to a projected benefit in 100 years' time having 14 times the value of a 5% discount rate. So that just gives you an idea of the kind of scale that we are talking about here. It is big. So as I said, this will be a game changer, particularly for that slow-growing, long-lived natural capital. That sort of stuff hasn't been a problem in the past because we have, with a lot of discount, where discount rates tend to be used, it tends to be for built capital, and built capital, it depreciates quite quickly. So, having a high discount rate hasn't mattered too much for that sort of thing. But for things like the environment, which, hopefully hangs around forever, certainly with the exception of pests, weeds, and climate change, doesn't tend to depreciate. It makes a really massive difference to those future benefits which go out potentially hundreds of years. Just a couple of thoughts just to finish on. Great that we have lower discount rates, but this now increases the premium on having good quality environmental information with which to do our cost-benefit analysis. Now, the Treasury CBAX has some environmental values in there, but there's a lot more work that we can do in that space. And the Office of the Parliamentary Commissioner for the Environment is willing to work with whoever's interested in this space to build out those CBAX valuations so that we can have a much broader set of ecosystem services valued within these sorts of cost-benefit analysis processes. Now that we've got a lower discount rate, these numbers are going to actually matter, hopefully. Which brings me to my next point. How important is the discount rate in decision-making processes? Of course, we have a technical discount rate, but there's also a political discount rate. So we don't know. We are yet to see the first set of decisions that this change will impact upon, and I think it's just going to be fascinating to see how much of a difference this makes compared to other constraints such as budget rules, which are there for a reason. And the last question I just want to pose is, when is discounting inappropriate? When should we actually not do it? I think we have to think about this. As Arthur and Chris have both set out, there is, we try to have these things be as technocratic as possible, to really just stick to what we call in economics the positive rather than the normative. But it's, as you can see with discount rates, this is impossible. These sorts of normative judgments are throughout these sorts of things. And in environmental economics, we have two concepts called weak sustainability and strong sustainability. Weak sustainability is this idea that you have natural capital and it can be traded off against other forms of capital in order to increase our overall supply of capital, which generates our future well-being into the future. Okay, so, and I think we can all see that that's reasonable in certain circumstances, and that's when you want to be using your discount rate to trade off these different types of capital against each other. We have another concept called strong sustainability, which says actually there comes to points where we're not prepared to trade off anymore. And, we embed that in legislation, for example, with our conservation estate, our national parks, we are not prepared to trade off with other types of land uses. I'm sure you can imagine what they might be. That's a concept that, a philosophical concept which impinges upon when we use this in policy situations. And I think we have to keep this in mind. The sorts of normative issues that Arthur and Chris have raised run right throughout discounting, and we need to be mindful of those, of when it's appropriate to use these processes and when not. Thank you.
Kira, it is a great pleasure to be here. I honestly didn't think that we would ever get here, but we are here with changes. And the PCE report that Geoff talked about was the prompt for the Treasury work on public sector discounting. Our parliamentary systems work, we committed to parliamentary select committees to consider hyperbolic discounting as a way of giving greater weight to long-term impacts and cost-benefit analysis. There are no easy answers. It raises technical and ethical issues. In the policy work, Treasury was mindful of diverse views, the extensive literature, the policy importance of the long term, and the different practices internationally. I would like to acknowledge the insights we've had from many people. We build on previous work, such as the Treasury 2007 working paper by Creedy and Puzzy. The United States undertook policy work and engagements in 2023 with significant debate and very rich contributions. Engagements with international experts such as Dr. Ben Groom and Dr. Cameron Hepburn help guide our work. New Zealand experts, including Arthur, Dr. Andrew Coleman, Zach Turk, contributed. practitioners, such as the group of public sector economists, were really valuable in terms of testing and developing options. So when we approached this work, we thought it was really important to get some good underlying thinking in place. So we invited ARFA to give us expert insights, and also Peter Appleson and Tim Dalton from Australia. And as we were considering hyperbolic discounting, where it all started, it became clear that it wasn't the way to go. And instead, we started considering other options. So it became clear that we needed to think about different methodologies on top of or instead of the SOC approach, which has been in place since the 1970s in New Zealand. It was clear that a declining discount rate worked potentially with SRTP rates, but not really with SOC. Also, it became clear that we needed to think about both commercial type proposals and non-commercial proposals, and that stems a lot from the recommendations and the work that ARFA presented to us. I highly recommend looking at the background papers, which are on the Treasury website. They also talked about considering the SRTP rate for non-commercial, including the declining discount rate and multiple rates as well for different types of impacts. This is to give you a sense of just how varied the international approaches and rates are. So the dark green ones are where we're now sitting in New Zealand. So we got the 2% SRTP rate for non-commercial and 8% real for based on a SOC methodology for commercial proposals. But as you can see, there's quite a variety of both rates and approaches used internationally. The trend, I must say, is going more towards more countries taking up SRTP. There's a few that's got combination of rates. So the ones in green have got the combination of the yellow and blue. But most countries came from a SOC legacy, if you like. That's where most rates used to be. What you'll also see is that rates for developing countries tend to be a lot higher, and that relates to the growth rates, expected growth rates that both ARFA and Chris talked about. So when we explored the SRTP options, in a sense, we were really lucky because we've got some good international examples and practices that we could build on. So the UK have had an SRTP approach in place since 2003, and the rate has been at 3.5% since then. So that was very low at the stage when that was implemented. Over time, it's become more sophisticated in the sense of having both declining and multiple rates. So they've got different rates for health and environmental impacts. Also, they've found ways of looking at specifically some of the intergenerational issues within those. So it starts becoming quite complex because there's quite a lot of different rates. And as you can see, Chris was talking about the steps in the rate over time. They've got quite a few steps where we've kept it simpler. The US changed to using a risk-free rate estimation of the discount rate in 2023. There's a lot of material available, and there were lots of international big hitters involved in debating where they ended up. And so they basically ended up with a 2% real and declining to 1%. I would really like to highlight the key role that our chief economist group in the public sector played through all of this, and this is part of why things take time. We do need to discuss, listen, have room for making changes, getting ideas. And it was, to be honest, a reasonably tricky process for Treasury because I didn't want us, to be frank, I didn't want us to be pushed into a corner. There was a lot of views, and we've had over the years lots of people criticise where Treasury was sitting on the public sector discount rate. So I wanted to open it up to allow proper conversations around it. And I'm really grateful to the chief economists for their contributions and their engagement, which help build the confidence in making changes. So in general, people have welcomed the update. People understand that the fiscal constraint remains. That this is about making the longer term matter. Interestingly, SAC-TURC published a paper in 2024 and that indicated, so he surveyed New Zealand experts and users of the discount rate, and there was a preference for SRTP. So that was also part of giving us greater comfort and confidence in making quite fundamental changes. We will learn as we implement, so I'm quite open that we don't necessarily know what this will mean in practice, how people will actually apply it. We know that was part of why we wanted to have mandatory sensitivity analysis. So we're asking people, even if you decide that this is a non-commercial proposal, that you actually run the sensitivity analysis. So you use both rates in everything you do. It's just dependent on what's your default and what's your sensitivity analysis. And part of that is that openness about what is this telling us as we practically implement it. The advice on specific proposals and their relative rankings may or may not differ under each rate. Understanding how the benefits and the cost develop over time becomes much more important. And so does the understanding of the underlying intervention logic and the commercial and non-commercial nature of a proposal. These are interesting conversations, and I'm really looking forward to actually putting discounting sort of almost in the background and then getting on to having really good policy debates about how do we understand what is the nature of the proposal? As Chris was talking about, how do we understand market and government failures and the way that the proposal is contributing? How do we understand the nature of the impacts, and especially thinking long term, getting people to really understand what do the streams of benefits and the streams of cost look like longer term. So I think those are much more interesting conversations, and hopefully with the discounting changes, that's enabling us to shift the focus a bit in public policy. So let me finish with the updated rates. As you can see, yes, we have got a new kid on the block, the SRTP rate. We don't let go of the old kid on the block, so we keep SOC in play as well. Mandatory sensitivity analysis is really important as we implement this change. SRTP for the first time in a New Zealand context. Chris did some absolutely amazing work. We didn't have an estimate, a New Zealand estimate for the SRTP rate, and Chris developed that. And I think what he did is actually quite outstanding internationally. So I think he's lifted the game of how we set the SRTP rate. Very innovative, Chris. And I think even though we didn't quite follow exactly the recommendations by the PEC or by ARFA, I think that hopefully people can see that we've listened, and that we have made use of the different insights that have been available to us. I trust that where we've landed, including Chris's innovations, is going to take us forward and will stand us in good stead. I'll now hand over to Tim for the questions. And yeah, I look forward to your questions and discussion. Thank you.
Well, let me begin, of course, by thanking our panelists for the really interesting presentations. Pretty clear, I think, that this is a contentious topic that embeds ethical judgments as well as the sort of technicalities of, quite complex mathematics of dealing with the future. So now we're going to have some time for questions, have about half an hour. I'm going to sit down in a second. I'll invite the panel to take some comfortable seats here. I'm going to sit down and moderate the questions in a second. We already have some questions online, so please keep them coming. I've already got some to start with, and I'm going to try and make sure I cover questions in the room as well as online. So let me just sit down so that I'm joining the panel. That work? Okay, I hope that's working for people online. I thought I'd just start with a question that's come through online partly because it's had a lot of likes, which is good. So lots of people are interested in the answer to this question, and there's some supplementaries as well that have come through. So I can deal with quite a few at once, which is always quite good as a chair. So the question is from Ben Smith, and with some supplementaries from Matthew McFarlane and Alexandra McMillan. The question goes, thinking about cumulative effects and tipping points, particularly in relation to GHG emissions and other environmental impacts. Do the speakers have any advice on using negative discount rates, as sensitivity tests of the potential for increasing harm? Matthew adds a supplement to that, is that, how do we deal with extinction risk? There is an apparent assumption, in some circles at least, that extinction risk is totally external to policy. And then finally, how should we account for differences in the dynamic shape of benefits and costs, accruals and degradations? For example, contrasting the rapidly declining benefit to the time savings of a new motorway versus long-term growing and cumulative benefits of active travel. Who would like to begin with that one?
Okay.
Yep.
Thanks, Tim. Thanks for people who asked those questions. Actually, in my paper, I dealt quite a lot with the literature on tipping points. Some people have argued that we should have used the discount rate to take into account tipping points. I argue that what we should do is value the costs of tipping points properly, and they'll be very, very high costs, potentially with a probability distribution over them, and not use the discount rate for that purpose. But we, rather that it's the valuation of the effects of the tipping points, should be very explicit and built in, and we shouldn't muck around with the discount rate for that. But there is a large literature which mixes the two. And I think literature is sort of out on that. On the extinction risk, that is a standard part, and you'll see Chris would have brought that in the annihilation rate, so he may want to comment on that. The rest of the questions, I couldn't quite follow all of them, so I'll give them to someone else.
Yeah, I mean, just building on Arthur's answer, I mean, this goes back to my point that there's some things that perhaps we shouldn't discount, and there's environmental bottom lines. The difficulty is knowing where those environmental bottom lines are before you cross them. And a lot comes down to our attitudes of risk, and we're not particularly good at having those sorts of conversations, as a society about our different attitudes to risk. But just on the climate, if I'm to grossly summarize the problems that economics has had with assessing the size of climate risk, it's well, you take the models, and climate tends to affect the energy sector and agriculture, and they're not a very big part of the economy, so don't worry about it. Now, I think we can all see the kind of flaws of that approach. If you don't have energy and you don't have agriculture at all, then you start getting into some pretty tricky territory. But I think valuations of the impact of climate change are starting to improve markedly at the moment. So we should have a better shot at what Arthur's suggesting.
Kia ora. So 2 points I'd raise is one about the limits. The RMA reforms have a principle to explicitly put limits of natural environmental degradation allowed for. And so that will facilitate, as Arthur talks about, valuing costs and benefits at an increasing rate as those tipping points are reached. And a second point I touched on my report at the back is when the growth rate in society might be affected by your policy, then the social rate of time preference doesn't work because it assumes that that's a given and you're only going to take like a marginal one step off the beaten path. But if you're going down an entirely different beaten path, then you need to go back to the more fundamental basis using the pure rates of time preference and explicitly modelling the utility over time. And that's what the Stern Review did. And most people didn't actually understand what the Stern Review did. Confusing. He was a bit ahead of his time. And so, yeah, I talk a bit about that in the annex of my paper. And I can talk to the second question, but I'll let you. Yeah. So motorway benefits and active travel, sort of my area, urban policy, transport. We've got some real flaws in how we do CBA on those sorts of things, let alone how you apply the discount rate, because particularly in urban areas, which urban active travel would be and motorways are, is that they can change the evolution of cities over time and change land use and change land values. I went into this area after we started lowering the discount rate, because when I started, we had a 10% real discount rate. Nothing after 10 years mattered. We started to lower that, and now then it came as Geoff said, now we need to actually think about what are the benefits and costs and consequences in the longer run. And these assumptions of holding land use fixed with respect to the policy shock is good in the short run, bad in the long run. So yeah, we're still researching how to change CBA to understand land use change and land value change and subsequent effects on how you fund these projects, and should it be from land value taxes, and do they have any effect on land use or not, and the institutional forms for doing that. So as for monetary motorway benefits having declining benefits, probably I wouldn't be in that camp. And if there are concerns about emissions, then that can be taken account of with emissions pricing and the transport fleet. And active travel is probably good at getting a lot more population density in a city in a way that doesn't congest as much, and that's good. But it's much more localized, whereas motorways projects can have quite wide area effects as well. So. Punchline is we need to do the CBA on this because there's a lot of trade-offs and a lot of different effects. That's why we like CBA, and lower discount rate would be a good pathway to helping focus on the fundamentals, as Kirsten said, rather than, thanks.
Just a couple of brief comments. We really support where Arthur was coming from in terms of thinking about tipping points. And this is where we are really putting emphasis on people understanding what do the benefits and the cost look like over time, and how do we estimate those. So a bit of a challenge for all of us, I think, with these changes is starting to emphasize that. The other brief comment I've got is that while I'm all about cost-benefit analysis and understanding impacts, it's not the only tool in the policy toolkit. So it will sit alongside other perspectives that you might have. So we don't need to load everything into a discount rate. We can take perspectives on different options other than the impacts. And I think a lot of the ethical considerations you might actually want to do in addition to doing a CPA. So it might be that you are considering, say, for example, human rights aspects that's not necessarily very easily dealt with in a CPA context, but where you can definitely have it as part of your decision making. So just a plea that discount rate doesn't have to do the heavy lifting on everything, but it should be part of stimulating how we think about what the impacts are alongside other considerations that we might have.
Thanks, panel. I'll take one from the room now. There was one at the back, I think, first, and I've got one here that I've mentally noted.
Hi, Martin Lally. A question relating to projects that have exclusively market payoffs. Arthur, it seems clear from your work and what's ultimately been determined here by Treasury is that for these sort of projects, you want the public sector discount rate to match the private sector discount rate. And the formula you're using for determining the public sector discount rate, that can be interpreted either as a pure cost of equity, an unlevered cost of equity, or mathematically it's equivalent to a weighted average cost of capital where the cost of debt is the public sector borrowing rate. Now, if you compare that to the private sector, weighted average cost of capital, cost of equity formula is the same, the cost of debt isn't the same. Cost of debt in the private sector is higher. You've got government stock rate plus debt risk premium. And part of that is the illiquidity, relative illiquidity of private sector debt. So what's happening, you've got this, we want the public sector rate to match the private sector rate. It's not. The private sector rate's going to be higher. The public sector rate's going to be lower. And for a good reason. Public sector capital is cheaper. So I don't think you want to align them, and you're not. So comment on that?
Yeah, thanks, Martin. Andrew Coleman's written an excellent paper on this, and you've written on it, obviously, as well, that the public sector has a lower cost of debt capital and for various reasons. There are also externalities, I suppose, of the public sector building up large debt. So, which then does flow through to the private sector if there's a credit rating downgrade or something like that for the government, that then flows through to the entire economy. So, I think there is a difference between at the margin there's what you say is correct, but what the government borrows, if the government was to borrow a lot on that basis, it would increase the rate of borrowing, not just for the government but for everybody in the economy. But there are technical issues here. I follow the who was it? I think it was Chris saying it's the important part of the change from last regime to this regime is to get things roughly right, that rather than precisely wrong. And I think where we've got to is getting things roughly right, and there are always going to be these things. I mean, the main criticism I would have of the current Treasury thing is that it doesn't take into account risk on the equity side, or on the debt side for that matter, appropriately. It just applies a constant 8% for everyone. But from a theoretical perspective, actually, the risk premiums could be very, very different for government projects. And I'll give you one example. We know from work that Treasury did many years ago with Bob Buckle and others that drought has a large effect on the entire economy. Okay, it's a very large very large effect. So, in other words, drought is going to be correlated negatively with the state of the economy. So, in that case, irrigation schemes reduce the effect of drought. Should have actually a negative risk premium rather than a positive risk premium on them, so I think there's a lot of work still to be done in Treasury to think about what's the appropriate risk premium to apply, and you've talked about another difference there, which is the different cost of debt. I would have thought the risk premium was actually the bigger issue.
I think it'd be, we don't want to go down a rabbit hole here, but irrigation schemes. It's similar to Chris's point about induced demand when it comes to motorways. There's some debate over whether irrigation schemes reduce the risk of drought or potentially increase it over time, because you get a resulting increase in the intensity of land use. So this.
Thanks. I've got another question online.
Oh,
go ahead, Chris. Sorry.
Yeah, thanks for your comment, Martin. You've talked about this in the context of PPPs, which has been a value-add contribution. I hadn't thought about it in this context of the social opportunity cost, so we'll do in terms of if the purpose of it is to replicate what the private sector is doing, then unpacking that a bit more could well be warranted.
Thank you. I'll take one online, which is on a slightly different perspective, which is from Andrew Coleman, who's been referred to. Yeah. You can always rely on Andrew to ask a sort of orthogonal question, or indeed give an orthogonal answer. Hello, did the Treasury consider, hello Andrew, did the Treasury consider a distinctive Māori view on the discount rate? Do you have any reasons to believe that there are different cultural approaches to discounting? To comment on that?
So yes, we did look at getting some advice as well, though it didn't quite pan out. But there was, with the testing that we did, there was a lot of comfort around making changes, though there wasn't particular views on what the discount rate should be, but a general sense that actually what they really wanted was that we started thinking long term. So the change is consistent with a view that was coming through in terms of putting more emphasis on what happens long term and intergenerational. So we did try to get a specific expert report from a Māori perspective as well. It didn't quite pan out, unfortunately, but yeah, the testing we've done is supportive of the travel that we are doing.
Yeah, we could have looked at that a lot more, could still do as well. I mean, drilling into a Te Ao Māori view. So my understanding is Māori, many matters, there's no difference between the past, the present and the future. We're all on certain matters. There is no concept of time, it's here and now. But also a lot of iwi are doing a lot more commercial investments, and some of them are becoming real economic powerhouses, and that's really important for building the prosperity of their different iwi. And so I think having the 2 discount rate policy is quite good for shifting hats and depending on the context of the issue at hand. And thinking more intergenerationally is definitely a step in the right direction. So from what I've seen.
Just an empirical observation. Some years ago, Robert McCulloch and Fraser Mackay and I, Fraser, as it was a Māori intern that we had, looked at the World Value Survey data for a question on would you favour economic growth even if it's at the expense of the environment, or would you favour environmental protection even if it's at the expense of economic growth? And we could divide that up between Māori and non-Māori in New Zealand. And there was a slight preference for the relative to Pākehā New Zealand, is a slight preference of Māori to favour environment, but only slight. And both were very similar to each other relative to, say, New Zealand versus the US, either black or white Americans. So there wasn't a big distinction between European and Māori New Zealanders on that, but just a slight one. So I don't think it would actually change the major, from an empirical point of view, it wouldn't change in a big way that row, the rate of pure time preference. It would be more an ethical overlay on it, I think, rather than changing the actual numbers.
I guess potentially it could be a different valuation over the different types of goods and so on. Yeah. Okay, there's been a lot of hands up in the room, so I'm going to try an aggregation scheme, much as we're trying online. We had a first over here and then here and Michael. So can we start with this gentleman, please? And then I'm going to ask it, have you got something to add to that question, or is it something completely different? And just to emphasise on my crack to Andrew, I really support orthogonal questions and answers because that's how we learn. Yeah.
Thank you. Rafe Chapman is the name. Can I ask whether the Treasury feels embarrassed at all about how long it's taken to revise the discount rate and to recognise the social rate of time preference? It seems to me that it's been going on for, if you like, decades too long. And I used to work in the Treasury decades ago, and the ideas were being bandied around. We had a fillip in the a lift in the discussion of it around the time of the Stern Review domestically, because Nicholas Stern, the author of that, government chief economist in Britain, said, look, if you're thinking about climate change, you really ought to be thinking about a very low discount rate. There was a lot of resistance to that, but it's something the Treasury ought to be giving a lot of thought to at that point, it seems to me. And the other aspect I think we should really be asking Treasury about is, and Leslie, you've raised it, are we getting these valuations of damage costs of climate change right, or in the right ballpark? And, we've had years where Treasury has sort of accepted that the damage costs at the margin might be, $50 a tonne or something like that, that sort of order of magnitude. But what if they're $1,000 a tonne? So I would point to a number of areas where Treasury has dropped the ball, or it's left it sitting on the ground for decades. And is there any sense of embarrassment around that?
All right. Do you have a supplementary to that? Yours is different. Okay, Michael, do you have anything to? Okay. Oh yes.
It's to do with
people online.
It's picking up on the social cost of carbon issue, because if we're going to, the discount rate is fantastic, thank you so much, but we have to value something. Here's an example. The government needs to decide this year whether to take the Climate Change Commission's advice to tighten our climate targets substantially. When I plugged in the numbers from the US process that you referred to, it looked like we could cause $80 billion worth of extra climate damages by 2040, staying on the current track, as opposed to tightening the targets. And so I have a question around, CBACS is great and within the sphere in which it operates, but how do we bring this thinking into those kind of wider, deeper policy questions?
All right, thanks very much. I'll hand over to the panel in a second, but let me observe that there's actually quite a lot of issues wrapped up in those questions, putting aside the embarrassment one, which I'll let you address. And part of the reason why things take so long is because sometimes people want to make a point about the time profile of costs and benefits. Sometimes people want to make a comment about the magnitude of costs and benefits. What we're here to talk about is the discount rate, which is actually only a small piece, is one piece of a cost benefit analysis. So I just want to make that observation, and picking through what it is that people are concerned about: discount rate, magnitudes of costs and benefits, time profiles of costs and benefits. That's what takes a lot of time, because in the process you uncover, quite a few ethical differences in ethical perspectives on these costs and benefits, as Arthur's pointed out. So our panelists, maybe a Treasury, maybe let's just stick to the facts, shall we?
So I think it's a fair point that discount rate, there has been criticism of Treasury for a long time. And on the other hand, there's not necessarily been a clear way forward for a long time either. So about 10 years ago, we did do some work on discounting. So I referred to the working paper from 2017. And again, one of the key things that came out of that work was that there's actually pros and cons. There's good aspects of different ways of doing it. So there wasn't a clear way forward at that stage. What we did do, for those of you who have been using the CBACS model, is that we included an alternative rate in the CBACS model. So while SRTP has not been formally in the framework, we have encouraged people to do sensitivity analysis where they could take other views than what our standard rate was. So personally, I've long wanted us to have a good look at this, but also a plea to understand that this is not necessarily an easy issue to get some agreement on, and ways of moving forward across the public sector. So we needed to take it at a pace where we could both get internal and external support for the changes. And I hope that that's where we've landed, even though it did take a bit of time. In terms of some of the work ahead of us, I absolutely agree that there will be quite a lot of work in understanding the profiles of impacts. And my hope is that that's where we actually put much more effort into understanding both how we value different impacts and how we estimate the magnitude of impacts, and looking long term. I think that's the invitation that these changes is making us. Let's have a better look at that in the future.
Okay. Oh, yeah, you go.
As for Treasury's historic policy, I think it's probably important to reflect that this is a harder area than perhaps we've conveyed, because of I described that we've jumped from one existential policy question to another. From one is, what's our long-term view? How do we have sight of the future? The other one is, what's the role of government? So Treasury, when we set this in the 70s, we had a much bigger role of the government, and we were trying to tame it. So that's why we erred on that. And now as I was talking to a bit about deploying the dual discount rate, it's no easy issue, because particularly when you've got long-term issues that can't pass under the higher SOC, but do under the lower, and you start to drill into that, it's quite challenging. But I would far rather us be deployed and thinking about those issues than probably the ignorance is bliss approach of just saying the discount rate will do it all for us and we don't even need to think about market failure or government failure or anything. So if anything, now the job's harder, and that's the right way it should be.
Just wanted to finish with your friendly reminder that there's a lot of work to do to value environmental costs and benefits into the future, and if anyone wants to collaborate on a cross-government approach on that, happy to talk, because we're going to have to chip away at this over a number of years. But just to slightly defend my Treasury colleagues here, another friendly reminder that there's a lot of positive and normative issues wrapped up in this sort of stuff, and that we look to our elected representatives to guide us on the positive side of things, on the normative side of things, and we're supposed to take care of the positive. And so, that is a delicate balancing act for my colleagues.
All right. Yes. Then I'll see if Michael is similar.
Yeah, thanks. I just want to say it's definitely a complex issue, and thanks for the leadership in the thoughts. And I've got a question regarding, so basically lowering the discount rates have one implication that we might be having a better preference for longer term projects. And do you think that poses to a risk that we might be less adaptive to regime shifts or transformational shifts that might be happening in the future? For example, for transport, if we're now investing like a lot of money into 60 years, that might be still focusing on, say, traffic capacity. But in the future, maybe with autonomous driving, and also maybe people are carried by drones, I don't know. Does that make our investment less protective against those regime shifts?
Thank you. Michael, do you have anything to add to that, or is it a separate one? No. Okay. Sure. We have some questions also about risk coming through online. So I wonder if we could restrict our comments to the discount rate framework aspects of treatment of risk, just so we can get through other substantive questions. We've got about 5 minutes left. So
can I just go very quickly? So the discount rate, I think, should take into account an explicit risk premium for SOC proposals, is my answer to Martin suggested. On your point, I think it comes back to that CBA is not the only game in town, and in your case, what we're talking about is real options analysis, because we're going to learn about those options in the future. They're valuable, and so that actually puts a much higher hurdle rate before you actually go ahead with an infrastructure project, if it might become redundant later, but that's separate from the discount rate.
Okay, Michael.
Questions. One was just about the process. Listening to this and reading your papers, I didn't get the sense there's been any consultation with the private sector. If that's so, why? And then the second question was about the split between commercial and non-commercial. If you think about health and education, for example, in principle, they could be commercial products. What's Treasury's approach going to be to advice to ministers around which discount rate to use primarily in those sorts of projects?
Okay, the second part overlaps quite a bit with questions that have come through online on the apparently binary distinction as something market or non-market, or commercial or non-commercial, and how we might sort of work through that. So please focus on that one, I'd suggest. Anything to add to that line of questioning?
Maybe related. I just wonder, these questions are really hard. How do you see the role of AI?
Okay, maybe it's the commercial, non-commercial aspect, and the private sector consultation, I think, should be a pretty simple answer, actually. Yeah, just the general principles of how we would advise agencies to navigate things that are mixed commercial or non-commercial.
Yeah, it is going to be a challenge. So the first thing is that we do ask everybody to use both rates. So the mandatory sensitivity analysis is a way of managing that we don't necessarily know exactly where we're going to end up. So we're keeping it reasonably open in terms of saying, well, let's look at specific examples. We did try to develop principles, and we got a little bit in, if you want to have a look at the Treasury circular that's on our website, we've got a little bit of some pointers, but we didn't want to tie it down too much. We wanted to leave it open to learn from specific examples as we're going through. So it may be something where hopefully in, say, 3 years' time, we might have a clearer principles based on the actual practice and specific examples that people are dealing with. But the short version is everybody's got to do both. And if they lead to different pieces of advice, then you need to really think about it. And you need to explain it to decision makers. Why does it lead you to different conclusions using the different rates? In a lot of cases, it does not matter. So I don't want people to get all tied up in knots when it doesn't necessarily matter. And it really depends on what the profiles of the benefits and the cost streams look like over time. So really open to learn from practical examples rather than setting down too tight a framework up front in terms of how are we going to see what is commercial and non-commercial. And a lot of things will have some aspects of both in there. You know, we're basically wanting to learn from practice in the coming years.
Yeah, and Kirsten and I are meeting agencies as they're trying to deploy this to understand the issues, informing that guidance work we're developing. Look to, there's no reason should consult wider too, because it's a work it'll take a long time. It'll probably always evolve as we learn more. So with the private sector as well. A lot of public sector issues are becoming much more mixed as we look for different innovations in raising revenues, finance, bringing commercial disciplines. As I think about this guidance, some things that are more commercial than social could, a different way is to calculate what the public sector subsidy is, the effective subsidy, and then have a more explicit option of maybe tendering that out to see if firms want to do that. As I look at the way we do CBA, say, of subsidies for commercially supplied public goods and services with local government outsourcing things, and I'm seeing some problems in the way the BCRs are done is that they miss the costs of the private sector supply. So even just bringing this lens and going through it is starting to highlight a bunch of opportunities for some quick, easy, low-hanging fruit improvements.
I'll just make one comment on the AI side. Remember, this is a technical and an ethical issue. AI might be fine to summarise the technical arguments. I wouldn't trust it in the slightest to do the ethical arguments, and it depends which literature has been scraping as to what it would come up with. So remember, this is an ethical issue as well as a technical issue.
Thanks. We've run out of time, unfortunately, so let me begin the closing remarks. Thank you very much to our panelists, of course, for taking the time to present on your work and to take questions. Thank you very much for everyone coming along to the Treasury here today and coming online. We've had a great turnout, which is fantastic. Thank you for the questions, and I hope you had satisfactory answers and that you learned something from the session. Those in the room, please join us for some refreshments. We do have some refreshments outside just after the session. They've been generously provided by our colleagues from Motu, so thank you very much for that. Chris, could you please come and finish our session for us?
Could do it from here even. Piki te ka, piki te ora, piki te wairua, hui e, tai ki e. It breaks the tapu, and putting some food to your lips will also help with that too. So, see you soon.